Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. This week I want to do something a little bit different. Instead of just a brief market overview, I'd like to take some time to really talk through some of the big macro factors that are impacting the market, and then we'll close later in the show with a few action items having to do with taxes, since 'tis the season, this is tax time. So to start out with, market-wise, we've definitely had some positive momentum. We've seen for the last 6 weeks or so, the market just continue to melt up little by little. We're not seeing those big, three-digit moves that we saw back in the end of 2011 or even the middle of 2011, but we're seeing 30 points up, 40 points up, 15 points up. So it's just slowly, gradually melting up to the point that we're actually almost back to the 2008 highs. In fact, today in intraday trade, today's Tuesday, in intraday trade, we hit 13,000 for the first time in a couple of years anyway, I guess about 4 years. So definitely this melt up is being caused by a lot of positive momentum in the market. Some of the things that are driving that momentum: number one, economic indicators are improving. Unemployment seems to be improving little by little. It's still in the 8.6 range, but it's not at 9.2 anymore. So that's a positive. We've seen some positive confidence sentiment indicators, seen that increase. So lots and lots of small moves, positive moves from an economic standpoint. And we've also had a lot of positive commentary from companies. Earnings reports coming in the first quarter have been very strong, or coming in the first quarter, about the fourth quarter, have been very strong. Not overwhelming, but positive, very positive, I think, is just the overall consensus. So that positivity is sort of driving the market up little by little. So we're optimistic, but we're very cautiously optimistic. And the reason that we're cautious is because there's still a lot of macro factors out in the market that really bear consideration. The biggest one, of course, is what's going on in the Eurozone and with Greece. The other is what's now coming to a head with Iran, or at least beginning with Iran, and what that's doing to oil prices and gas prices here in the U.S., and then what that's going to do to market volatility. So today I want to talk a little bit about the specifics about what's going on in Greece. We heard this morning that there is going to be a second Greek bailout. It sounds like they're all in some type of agreement that there is going to be a bailout. This is the second bailout for Greece in less than a year, and there's a question as to whether or not it will be the last. And I think it bears, I think that we should take some time to think a little bit about what is going on in Greece and just really dig into this in detail. So first and foremost, this bailout is caused because there is a large amount of debt, small amount of revenue in Greece. At this point in time, there's 120% of the revenue in debt, or the debt to GDP ratio is 120%, meaning that they have 20% more debt than they actually have in earnings, and those earnings come in the form of tax revenues. There's three things that are really driving this. Number one is the revenue side. Obviously, Greece is in a recession. Whether or not they're in a depression or not is questionable, but they're obviously in a recession. So the revenue side, the tax revenue side, the earnings is depressed, number one. Number two, of course, is whether or not they're actually bringing in tax revenue on any of those earnings, and that's something that, of course, the Greek government is dealing with. But number one, revenue is depressed. Two is going to be on the debt side. Actually, 2 and 3 are going to be on the debt side. So with the debt conundrum that they have, a lot of the Greek spending is public spending. It's the equivalent of our Social Security and our Medicare spending, a lot of public programs. The retirement age in Greece, I believe, is still 55, so there's a lot, and yet their life expectancy is still just as high as it is here in the United States. So there's large public programs that require funding over in Greece, and that's where most of the spending goes. So as their population ages, just as ours does, their spending costs are going to continue to go up. That's one of the problems on the debt side. The other problem on the debt side has to do with interest rates. Because Greece's debt is perceived to be risky, their interest rates are higher than they are, say, here in the United States. And as they've gotten riskier and riskier, the interest rate that's being demanded by the bondholders has gone up. So instead of their debt, say, costing them 4%, or even less like it does here in the U.S., their debt was costing them upwards of 10% on the longer end. So it was becoming impossible to pay. Think about this from the family perspective for a second. It's like you're spending using credit cards, and you just continue to live a lifestyle that you can't afford using your credit cards. And after a little while, not only are your credit cards, or the balance is higher, but the interest rate on them is going to go up as well. And at some point, your family is not going to be able to even afford the interest rate payments. That's the problem that's going on in Greece. The solution that they've come up with is what I'd also like to talk about. Not just the austerity measures, but what's going on with the bondholders. So now that we've discussed the fact that our debt is 120% of revenue, the concern is that Greek debt is going up at such a rate that it will, by 2020, which is, 8 years away, be 160% of what their revenues are. So the goal is to try to keep that in check. It's not necessarily to get the Greek debt below 120%. In fact, the solution that they're coming up with is one that will hopefully get Greece's debt back to 120% in 2020. So basically they're saying, yes, we know that our debt as a percentage of GDP is going to continue to rise over above 120, but our goal is to have it arc and come back to 120% of GDP by 2020, as opposed to just continuing along at a steady clip and increasing. So the goal of this solution is to bring it back to 120%. And so, it's a question as to whether you want to call this a solution or not, but it's certainly baby steps. So the way that they're doing this is not just the austerity measures, but the other way that they're doing it is they're having to cut the amount of debt that the Greek people are taking on, and they're also cutting the interest rates. So if you look at Greece's debt for just a moment, their debt is comprised of private debt, meaning banks and other financial institutions, insurance companies, etc., and also sovereign debt. Well, the big issue that we've had, or that you hear a lot about, is whether or not the bondholders are willing to take a haircut. And what that means is that the private debt, the banks, the financial institutions, have to cut the amount of debt that they are holding, or the asset that they're holding in Greece, by some amount. And the amount that they've decided on, at least today, is 53%. So what that means is that every bank who invested $100 in Greece's debt is now going to have $47 in an asset. And not only are they only going to have $47 in that asset, but the interest rate that they're going to be earning on that debt is going to go down as well. So if they were earning 7, 8, 9, 10% before, they'll only be earning, say, 2, 3, 4% right now on less than half of the amount of debt that they had before. So that's one thing that's going on there, part of the solution that they've come up with. But because of that, because the banks have had to cut their debt so much, there are fewer lenders that want to go in to assist Greece in this problem, because they're looking at, well, do I really want to have a 50% haircut on my debt? So there are fewer lenders that are willing to go in. As a result, the IMF and the ECB, or the public institutions, are having to go in and bail them out in much the same way that that happened here, in the U.S. back in 2009. So now the countries such as Germany, France, etc., and the rest of the EU are having to agree that it's all right for their money to go into Greece, and that is what's going to fund Greece's government, or Greece's spending for the next foreseeable future. So it just begs the question of, is this actually going to be the final bailout? Is there going to need to be another one? I think that if you look at a lot of the metrics, it's very, very likely that there's going to have to be a third bailout for Greece. The real question is, how soon is that going to come? So that was just an attempt to try to explain a little bit about what this solution is in Greece. And I heard somebody say this morning on television that they feel that this problem is going to be much more, it's not just going to be an acute problem or a one-time problem, but it's going to be a continuous condition. And I think that that's a very fair analogy to make with what's going on in Greece right now. And so that's one macro factor that we're looking at. But it's not just Greece that we need to be concerned about. It's also Italy, Spain, Portugal. The risk there has subsided somewhat, but it's a very real fact that what's going on in Greece is also going on in those other Eurozone countries, and it's something that we need to be concerned about. It's also fair to say that if you look at the U.S. debt relative to our GDP, U.S. debt relative to GDP is right now 102 to 103%. That's expected to go up, but who knows by what percentage. It just depends which political party and which economist you want to listen to. But that is expected to go up because our revenues are also going down and our spending is also going up. So we have a great example of what's going to happen, what the ramifications are of that type of a disconnect going on in Greece right now, and seeing what's happening there. It's very possible that the same type of scenario could play out here in the United States. We have a lot of advantages that Greece doesn't have and that other Eurozone nations don't have, but it's very real that that type of situation could play out here in the United States. So that's just one big macro factor that we're looking at, one headline that causes us to be relatively cautiously optimistic. I don't want to sound like a naysayer, but definitely cautious as we look at the market going forward. So that's my little tutorial on what's going on in Greece today. And we're going to take a quick break. We're going to be joined by David Kroll in just a second with his Mortgage Minute. And then we're going to come back and talk about another one or two macro factors that are impacting the market that are causing us a little bit of concern or caution these days. So please join us back here in just a minute. I'm Emily Johnson, and this is Money Matters.
Hello, this is David Kroll from Mortgage Network for the Mortgage Minute. And about every 10th show, I tell you the same piece of advice, which is you need a plan. Every single one of us needs a plan. We live in a chaotic world. This is an election year. Greece is doing great today. Tomorrow it may be in the tank again. Your personal finances are up and down all around. Each of us needs a plan of attack. That's what professionals in the mortgage industry can do for you. That's what professionals and financial advisors can do for you. You just have to pick somebody, sit down, and come up with a 2-year, 3-year plan. Interest rates are going to remain extremely low for the next 2.5 years. We do know that. There are a few things that we actually know. There are many more that we don't. So get your plan together. Thanks.
Welcome back to Money Matters. Earlier in the show, we were talking about some macro factors that are creating some headline risk for this positive market that we have. The first one that we discussed was Greece, and we discussed it in great detail. This next macro factor I'm not going to discuss in as great a detail, but I think it's going to have as big, if not a bigger impact on the markets, continuing to go up little by little and also increasing volatility. And that factor is Iran and the price of oil. Because of Iran's actions involving Israel and also the fact that they are cutting some of their oil supply going over to some of the larger countries in Europe, oil supply has decreased. As a result of that, the price of oil is continuing to climb. Right now, the price of oil is approximately $104, $105 per barrel, which is driving gas prices here in the United States, where gas is actually relatively inexpensive, relative to European countries, driving gas prices up to the tune of right now about $4 per gallon. That is a key number for the markets. That $4 a gallon is where people really start making decisions as to, can I drive my car as much? Do I need to cut back on other spending if I need to use my car to get to my job or to get my kids to school, etc.? So the gas price conundrum that we have right now that's being driven by Iran's actions primarily could actually have a stalling impact on our market. And it's something that we're watching very closely. In addition to oil prices going up and gas prices going up, other commodity prices have continued to climb with this fear as well. You see gold again continuing to climb a little bit, and that's somewhat worrisome. So it's great that we've seen this positive momentum in the market. Again, we're cautiously optimistic, but the caution is being caused by things like what's going on with gas prices right now, which could really stall the somewhat anemic growth that we already have in our economy, and that's something that we're watching. And another indicator of this, or another factor that we continue to watch and we talk about it show after show, is volatility, or the VIX index. And you see this up on the top of your screen every day. If you're watching Bloomberg or flipping through CNBC or whatever, you'll see the VIX index. And right now that number is relatively low, but it's starting to inch up again. And it's low because of this consistent growth that we've been seeing. Just like I said, the slow melt up that we've been seeing in the market has caused volatility to decline. People are sort of breathing, a deep breath again. But it's starting to inch back up. And as we see that inch back up, it's probably inching back up because of some of these macro factors, some of these headlines: Iran, oil, gas prices, Greece, other countries in the Eurozone that are causing some of that volatility to increase. So that's just a factor or a measurement that we often use to see whether or not these headline risks are starting to eke back into the market. So that's pretty much all I want to discuss as far as large macro factors impacting the market right now. Again, we are on a positive, we're seeing a lot of positive momentum. There's a lot of positive news out there, but I think it's worth being very cautious cautiously optimistic, but very cautious as we head into the next couple of months, certainly the next quarter. So we will be back in just a minute. I wanted to end with a couple of quick tax tips as we go into tax season. Please join us back here in just a second. I'm Emily Johnson, and this is Money Matters. Welcome back to Money Matters. I'd like to close today with a few quick financial planning, tax planning tips, given that this is the season for tax planning. Number one, very basic. There's still plenty of time to make your IRA contributions for 2011. The amount of that contribution is $5,000 if you're younger than 50, and then there's a catch-up of $1,000 for a total of $6,000 if you're older than 50. You can make that contribution up until April the 15th for the previous year. Something to think about is whether or not that contribution is going to be tax deductible or not. That's going to depend on whatever your income is, your income, your family's income, depending on how you file, and also whether or not you have a plan at work. Roth IRAs are becoming much more valuable, much more of a consideration these days. You can only contribute to a Roth IRA if you have an income below a certain level, depending on how you file. But the great thing about a Roth IRA is that not only do the funds continue to grow tax-free, but because they were taxable going in, when the funds come out, they're not going to be taxed. So you can allow that money to continue to grow year over year. If you happen to be, and this is a quick tip, if you happen to be above the income level that allows you to make a Roth contribution, one alternative that you might have is actually to make an after-tax traditional IRA contribution, and then the next day you can actually convert that to a Roth IRA. So you're moving you're putting $5,000 into a traditional IRA after tax, and then you can convert that over to a Roth immediately after. So you're able to get around the income limits on an IRA or on a Roth IRA and still make that contribution to a Roth on an annual basis, if that works for you this year. Another quick thing to consider, is it possible that your kids could contribute to an IRA this year? Do they have any earned income? Did they have a summer job? That might be something that you would consider, say, helping them put $1,500, whatever, towards an IRA in their name, help them learn a little bit about savings and the tax deferral aspects of IRAs, etc. And then lastly, definitely a good time as well to look at 529s. If you have a 529 plan for your kids, your grandkids, or even if you don't, still time to put funds towards those 529s, and the funds inside a 529 grow tax deferred and come out tax free as long as they're used for education purposes. There's lots of flexibility with 529s. That's a whole another topic for another show. But those are just some quick tax planning tips that there's still time for this year. Go ahead and talk to your tax planner, your financial planner, and see if that might be an option for you. So that's pretty much it for today. Hopefully this was helpful. We certainly welcome all of your thoughts and ideas. Going forward, there's lots and lots that we have to talk about. I know taxes is definitely going to be a big one going forward. We're probably going to see a lot of changes there. Please shoot us an email. Check us out on Facebook, right on our wall. Welcome all of your comments and thoughts, and look forward to seeing you again next week. Until then, I'm Emily Johnson, and this is Money Matters. Have a great week.